All right, today we're going to be jumping straight into the video and we're going to be talking about asset allocation. As Ben Felix from PWL Capital says, when it comes to managing your own investments, there's so many things that you cannot or should not do, which means there's only a handful of things that you should do. And perhaps one of the most important things that you should do is determine your asset allocation. Asset allocation is especially important to understand when we're experiencing markets like we are right now. Stock markets have tanked quite a bit and nobody knows where they're headed next. So in order to not hurt yourself financially, you need to be invested in the right mix of asset classes. You may have heard of Ray Dalio's All Weather portfolio, which purportedly performed exceptionally well in down markets. According to an interview that Tony Robbins did with Yahoo Finance about the plan, you apparently would have made money just over 86% of the time. That's only 4 down or negative years, and the average loss was just 1.9%. Not only that, it returned about 10% per year on average. This was fully due to the asset allocation of the all-weather portfolio. Now, the all-weather portfolio actually isn't that exceptional of a portfolio when you compare it to other ones that have similar asset classes, but that's a topic for another day. In general terms, asset allocation just means deciding how much of each asset class you want to have in your portfolio. But what the heck is an asset and why does this matter? Well, an asset class is just a type of investment. So there's a few really common types, and that would be stocks, bonds, REITs, and you could even say cash equivalents like GICs. In today's video though, we're just going to focus on stocks and bonds as those are the two main asset classes to consider when building your own portfolio. So stocks are kind of like and then bonds are kind of like, but when you combine the two, you get the best of both worlds. I'm terribly sorry you had to hear that. So stocks are a traditionally high earning investment. They have the highest potential for large returns, but they also are the riskiest investment because they have the highest potential for large losses. Bonds, on the other hand, are more of a low to moderate earning investment. They'll never be able to post the massive gains that stocks sometimes can, but they have a much lower risk. They generally do not drop in value nearly as much as stocks can. Stocks are what allow your portfolio to shoot for the moon, and then bonds are what make sure that it's a smooth flight. If you watch my video on how to assess your risk tolerance, then you know that the higher percentage of stocks that you incorporate into your portfolio, then the higher return that you can expect. But in return for that, you also have to take on a higher level of risk. And I hope that after watching that video, it helped you maybe determine your own risk level and you thought to yourself, hey, maybe something like 80% stocks and 20% bonds is going to work for me. Well, that's great because today we're actually going to dive into this a little bit further and continue to unpack this so you can see how different portfolios would actually perform across a few different important metrics. After we analyze all this, there's a lot of really cool lessons that you can pull from this, and I promise you that you're going to feel a lot more knowledgeable and comfortable about having your own index fund portfolio. So I'm going to analyze 4 different mixes of stocks and bonds for you today. And the way we're going to do it is we're going to imagine that we invested $10,000 into each of them 25 years ago. So that's going to give us a really nice long timeline to look at how they performed in the past. And we're going to track this across a few different metrics. And those are going to be the average annual return, the total dollar value that you would have ended up with, the standard deviation, and the lowest 1-year return. So the average annual return is going to tell us approximately how much the investment increased per year. But remember that this number is an average. So when you're actually looking at the data, or if you're managing your own portfolio, you shouldn't expect your index funds to return you this amount every year. Instead, the way it works is that there's going to be a distribution of returns, and then when you take those over time, they average out to be this average annualized return. So you can think of this as more of like a trend line of your investments, and the 1 year returns would be plotted more like a scatter plot along there. The total return will show you how much money you would have ended up with after investing that $10,000. So this one's pretty straightforward. You'll be able to see in dollar value clearly which portfolio is going to earn the most money. But we have to pair the average return and the total return with risk. And the way that we're going to do that is through looking at the standard deviation. So standard deviation is one way we can get an idea of the riskiness of the portfolio. And that's because standard deviation essentially means how much a portfolio's return will deviate from the average return of the entire portfolio. So essentially what we're measuring is the fluctuation of the returns. And this fluctuation can be both up and down. So a higher standard deviation means that the spread of returns in your portfolio that you can expect is going to be higher. And a lower standard deviation means that the spread in returns should be smaller. I don't want to get too technical, but just bear with me for a second. So if we plotted this out onto a bell curve, essentially what this means is that 68% of the time you can expect your portfolio to behave within one standard deviation. So if your average portfolio return was 10%, and we use that as the middle line on the bell curve, then that means that 68% of the time your portfolio should perform within 15% of that 10% average. So that means within -5% or plus 20%. So to try and make that super clear, 68% of the time you could expect your portfolio to perform within that range. So hopefully that makes it a little bit more clear to understand how if the standard deviation gets bigger, then that means that that spread gets wider on that bell curve, and therefore means that the portfolio can fluctuate quite a bit more. And lastly, our lowest 1 year return will tell us the worst year that our portfolio would have experienced. So this is another way that we can measure the risk, because we'll be able to see here how bad the portfolio could perform in an economic crisis. Right now, a lot of people are getting caught off guard because they weren't prepared for their portfolios to perform as badly as they are right now. So it's important to really make sure that you understand and pay attention to this metric so you can use it as a guideline of what to maybe expect in the future and make sure you're prepared for your portfolio to perform at that level in an economic crisis. Oh, and something I should point out here is that I'm going to be referring to Canadian index funds for the most part, but if you are in the US and you're watching this, then you can replicate the same strategies by using the Vanguard index funds VTI, BNDX, and VXUS. All right, so let's actually look at these portfolios now. So the first one that we're going to check out has 40% stocks and 60% bonds. Now, this portfolio corresponds to the VCNS or XCNS index funds. So if you just simply bought either of those index funds, then that would mean that you would own a portfolio with 40% stocks and 60% bonds. And the stats that we're going to look at here exactly are taken from the Vanguard index fund here. So over the past 25 years, the average annual return of this portfolio was 6.72%. So for a portfolio that's heavily invested in bonds, that's still a really great return. And you would have ended up with a total return on your money of $50,832. So that's what you would have ended up with if you invested $10,000. So you would have quintupled your money. I remember when I was first studying this surprised me because I expected a portfolio with only 40% stocks in it to not be able to perform this well. But it turns out that even with just a modest amount of stocks in your portfolio, you can still see some decent returns. But the real benefit in a portfolio like this is the risk level of it. So our standard deviation is only 5.21%. So if you remember what I said about standard deviation, then that means that 60% of the time you could expect your portfolio to perform within about 5% of the average annual return. So that means 68% of the time you aren't even dropping below a 1% return. Now, obviously that's not 100% of the time, but that's still pretty good, and that's a low standard deviation. So that means that your portfolio is going to generally return within a pretty tight band of possibilities. And in addition to that, the lowest 1 year return was negative 13.56%. So it's still a little bit over 10% for the worst year in the past 25 years, but when you take into account things like the S&P 500 lost 56% at one point, being down 13% isn't that bad, especially for still being able to quintuple your money. So this type of portfolio might be ideally suited to somebody who's pretty risk averse, but is still wanting to be modestly invested into the stock market and capturing return that's higher than just what fixed income investments can offer them. And again, you can just simply buy the Vanguard Conservative All-in-One Asset Allocation ETF or the one from iShares as well. And that's going to give you this exact portfolio that we're looking at right now. Okay, now let's bump up the stock percentage a little bit. So now we're looking at 60% stocks and 40% bonds. So now we see that the average annual return has bumped up to 7%. So by adding 20% more stocks to our portfolio, we've increased our average annual return by a couple basis points. And that brings our total return now to $54,274. So it's not a drastic increase here, but you're almost earning about 10% more money in the end. And now let's look at the risk factors associated with this portfolio. So now we have a standard deviation of 7.23%. So you might have noticed that the standard deviation has increased more than the average annual return has increased. And this is something that's really important to notice, because risk and reward is not a one-to-one relationship when it comes to investing. Generally, you have to take on much more risk than what you're going to receive in return. So our standard deviation has jumped by about 2%, but our average annual return has only jumped by about 0.3%. And that's kind of the relationship between risk and reward. So just keep that in mind as you're considering adding more stocks to your portfolio. And we can also see here that the worst year that this portfolio had was being down 21%. So that's quite a bit more than the previous portfolio that we looked at. So again, this kind of further illustrates that if you're going to be seeking a higher return, you also have to keep in mind that you're going to have to be able to weather an increased risk for it. And there's nothing wrong with that. You just have to make sure that it's appropriate for you. Okay, let's continue to bump up our stocks here. So now we're looking at 80% stocks and 20% bonds. So this one is a very popular asset mix for a lot of people. And this corresponds to the index fund VGRO or XGRO. And those are some of the most popular index funds. And that's because they expose you to the stock market by a large amount, but they also have that bond component there to really help cushion against those big drops. So again, we have a small crease in average annual return, bringing it up to 7.22% now. And that brings the total return for our money to $57,134. So we're earning more money, but it's not anything crazy like doubling our money or anything like that. And our standard deviation once again is bumping up by just over 2% again. And the worst year for this portfolio is being down 28%. So you can still see this relationship happening here. Risk is increasing by quite a bit, whereas returns are only slightly increasing. Now we're going to look at the last portfolio here, and then we can look at them all together and analyze a few key takeaways. So the last one we're looking at here is 100% stocks, no bonds. So this would correspond to VEQT or XEQT. And if you're wondering what kind of stocks these funds invest in, for Canadians, it would be the Canadian stock market, the American stock market, the developed international stock market, as well as a little bit of emerging markets as well. So you're essentially investing in the entire stock market. You're globally diversified, which is what you want if you're investing for the long term. So this portfolio of 100% stocks had an average annual return of 7.36%. So it is the highest returning portfolio out of all of them, which is what you'd expect with 100% stocks. The total amount of money that you'd end up with is $59,028. So you're up almost 20% over the lowest returning portfolio out of the group here. But the standard deviation is now all the way up to 11.76%. So those are pretty big swings in the portfolio. And in addition to that, the worst year was being down 34.62%. So while it is the highest earning portfolio, you are going to have to be able to handle that risk level. All right, so now that we've looked at all the portfolios, let's talk about some key takeaways that you can get from analyzing them. So the very first thing to remember is that this is over a 25-year period. So you might be looking at some of these returns if, you're not too familiar with investing. You may have heard people talking about really high returns on investments like 20%, 30%, 300%. Keep in mind that this is over a 25-year period, and anybody who says that they can earn more than these index funds over a 25-year period is most likely full of crap. Or they're selling something, or they're taking on way more risk. So you always need to kind of pair the return of something with the risk so you understand its risk adjusted return. Because I can go and buy a put option on the market right now and potentially make 10 times my money. But I'm also risking the entire amount of money that I would use to do that. Another key thing to notice here is that the average annual return did not increase by a drastic amount. But remember that over the long term, small increases in average annual return actually ends up being a very large effect. Think of it kind of like something doing this. So it starts out, pretty close together, but then over time it spreads out and gets farther apart. So that's kind of how it works. Even though it's just a few basis points that it increases each time you add more stocks to your portfolio, over the long term, that actually turns into a bigger and bigger effect. And you can kind of see this with the total amount of money you would have ended up with. And that's because the difference between the lowest earning portfolio and the highest earning portfolio here was about 20% in terms of the dollar value. But if we're talking larger amounts of money, or if you're contributing to this portfolio over time, that again has a bigger effect on the outcome. But it also seems that by participating in the stock market only a little bit, even if you're only invested 40% into stocks, you still get a really good chunk of the returns offered by being invested in the stock market at all. The lowest earning portfolio we took a look at still earned over 6% per year. So even if your portfolio is really bond heavy, your investments can still earn you some good money. And that's important to keep in mind because risk increases drastically as you incorporate more stocks into your portfolio. We went from having a worst year of just over 10% all the way to just about 35%. That's a really big difference. A lot of people wouldn't be too uncomfortable with being down to 10%, but a lot of people panic when they're down 30%. So you really need to keep that in mind and remember that the relationship between risk and reward is not 1-to-1. You need to pay up more risk in order to get that little bit extra of return. But of course, that's not to say that risk is bad. I don't want you going away from this thinking that risk is bad. It's just that you have to make sure that you're able to handle it. Because if you were a robot and you had zero emotions, then you would obviously pick the highest earning portfolio if you were confident in the global economy continuing to grow. And that's because if you were a robot, you wouldn't be affected by the decreases in the market. But oftentimes when the market does decrease, like we're seeing right now, it's because it's really scary. Right now is a really scary time. I mean, we're quarantined. This is crazy. And so you have to make sure that you're able to stay calm when stuff like this is going on and not touch your investments. So honestly, a portfolio of less than 100% stocks is probably ideal for most people. And that's because we're not robots. By even just incorporating a little bit of bonds in your portfolio, something like an 80-20 mix, which is one of the most recommended asset allocations for people just starting investing, it still gives you a really good return, but it also gives you that little bit of protection that can mean the difference between you panic selling and you staying the course. So I think those are the main key takeaways that we can get from analyzing those portfolios. And I hope that this was really informative for you. So now you kind of get an idea of what all these different asset mixes mean. because soon, and I know I keep saying this, it's probably getting really annoying, but I'm going to be releasing the index fund portfolio tutorial where then I'll show you how to actually buy these index funds. But I really wanted to put this out first so that you understand what you're getting yourself into, so you can see all these important metrics, and so that you're just not blindly following somebody or something you read or something like that. I want you to be able to make your own decision about it based on the relevant information. And so with that all being said, I'm Steve Antonioni, and this has been Cash College on Asset Allocation. Stay safe and stay healthy out there, and I'll see you again soon.